If you are a passive income focused investor, Harvest ETFs has an absolute treat for your portfolio. Hold on to your seatbelts, folks. This is going to be a good one. When it comes to the big dividends on the block, most investors have been focusing on those purpose high yield ETFs, which, in all fairness, they have put up some impressive yields. However, is that about to change? As we have some new contenders from Harvest that want to challenge for the title of Best Income ETFs. Harvest has just released their latest series of income ETFs called High Income Shares. This group uses covered calls, or covered calls with leverage, on some of our favorite US stocks to bring those nice yields north into our Canadian portfolios. Their initial offerings include Eli Lilly, Amazon, Microsoft, and of course, you guys know it's going to be there, NVIDIA. Each stock will come in 4 different offerings. So in total, they're actually dropping 16 new ETFs. That's not too shabby. So what are these different offerings? Well, let's look at the first one. First, each is going to get a covered call version. These will be ETFs that write covered calls on up to a maximum of 50% of the fund to, of course, enhance their payout. In a nutshell, covered call ETFs can provide higher yields by selling call options on their holdings. This generates additional income from those premiums or the fee that the buyers who pick up those options have to pay for that opportunity. Those options, of course, give them the opportunity to buy the stock from you at a later date at a specific strike price. And those premiums, they can definitely be used to pump up the dividend. And that's exactly what we're going to see here today. However, in exchange for this income, and yes, you guys know you never get anything completely for free, that ETF does have to give up some of their potential upside. So if the stock rises significantly above that strike price, that price where the option buyer gets guaranteed to be able to buy at that price, well, they have to sell it at that price. So sometimes they're actually selling it for less than what they could have had if they didn't have an option on it. So in other words, this will tend to make a covered call ETF underperform in a strong bull market. Of course, you are getting those really nice dividends, so that certainly narrows that gap in that strong bull market. That was the first one. Now, we are also going to be having a version that has covered calls and leverage. We're talking 25% leverage in addition to the covered calls to add one more way to take those yields even higher. What this means is that the fund will use borrowed funds to increase their exposure to the underlying asset by, well, as I said before, 25%. So if you invested $100 into that ETF, they would control $125 worth of stock. The goal is to amplify the returns. If the underlying assets go up by, let's say, 10%, the ETF might return approximately 12.5% because of that leverage. However, it works the same in the other direction too. The leverage also amplifies losses. So if the asset declines by 10%, I think you get the idea that ETF would lose approximately 12.5%. The leveraged portion is typically funded by short-term borrowing, and the cost of this borrowing is reflected in that ETF's returns. Speaking of amplifying returns, a sub to the channel is worth it's worth more than you think. So we have the covered call and the covered call with leverage version of each ETF. Those are both hedged to our Canadian dollar. They also have 2 additional ETFs for each company that is pegged to the US dollar. So we get a US hedged covered call ETF and a covered call with leverage ETF. That's pretty cool. Why, of course, would you choose a US hedged version over a Canadian hedged version? Quite simply, it does remove the currency exchange variable from the equation, and some investors are very keen on that. If you are expecting the US dollar to perform better than the Canadian dollar, these options may very well make a lot of sense to you. Also, technically, this would also offer you some diversification to the US dollar. Let's take a look at these ETFs in a little more detail. We are going to start today with Eli Lilly. We will start with their covered call version. So for the Canadian hedged one, we're looking at LLYH For that USD hedged one, we're looking at LLYH.U. The management fee on both of these works out to 0.40%. Now, we do not yet have a management expense ratio with any of these funds. I do expect it to be a little bit higher than the 0.40%. That just makes sense. Hopefully, we'll have that soon. As I mentioned, these all just launched in August. In fact, the first dividends are not even coming out until October. We got a little bit of room before we get more information. We're just going to do the Canadian version. The American version will fall in line with that. Their dividend, it works out to 16 cents a share. Now, they haven't yet provided an official yield on that, but if we use their NAV and that dividend, it works out to a dividend of 15.60%. Holy banana bread, that's not too shabby at all. Let's take a look at that leverage because we're going to see some numbers actually going up. So the ticker for the leveraged version is LLHE, and for the US version of that LLHE.U, the management fee, believe it or not, it's actually the same, 0.40%. I expect, now I could be wrong, but I do expect once we have management expense ratios, I do think that the leverage one will be a little bit higher, only because I do have to do a little bit more work to make everything happen. Now the dividend here, it's 2 cents higher, so 18 cents. That works out to a yield of 17.41%. Another interesting little piece of tidbit is Eli Lilly year to date this year has done 64.82%. So they're having a fantastic year. I think as well with these, I do want to touch on Purpose because as I mentioned, Purpose is doing kind of a similar thing with their high yield funds. In the case of Eli Lilly, Purpose doesn't cover them. This is the only Eli Lilly game in town when it comes to Canadian high dividend ETFs. Up next, we have Amazon. For the covered call version, for the Canadian pegged one, it's AMZH. For the USD pegged one, we got AMZH.U. I'm thinking there's a little bit of a trend. You're probably catching on to that. Management fee, once again, 0.40%. This one will have a dividend of 14 cents. When we work that out to an approximate yield, we are looking at 14.2%. On their leverage side, their ticker for the Canadian version is AMHE, and for that USD version, AMHE dot, you guys know what it is. It's a U, of course. A management fee, once again, 0.40%. This one does have a dividend 2 cents higher, so that's a 16-cent dividend, yield of 16.28%. When we look at Amazon this year, year to date, they've had a total return of 16.83%. So this is one where that upside capping has a less potential of happening. Looking at Purpose, Purpose does have an Amazon high yield, and yeah, they're only offering a yield of 9.21%. So the Harvest ETF, they are easily beating that. And we're talking by 5%, even more if you looked at the leverage. So Purpose, you're not winning this one for sure. Let's move on to Microsoft. Looking at their covered call version, the ticker for the Canadian one is MSFH, and for the USD one, MSFH.U. Once again, management fee 0.40%. The dividend for this one is 14 cents per share, so that does work out to a yield of 14.26%. When we look at their leveraged version, the Canadian pegged one is MSHE, and the USD pegged one, MSHE.U. Once again, management fee 0.40%. And that trend continues. That dividend goes up by 2 cents up to 16 cents. So that works out to a yield of 16.38%. Microsoft year to date comes in at 12.09% on that total return. So this is another one where you're not going to lose a lot on the upside potential. Purpose also has a Microsoft high yield ETF with a yield of 5.73%. So once again, these new Harvest Microsoft ETFs are kicking butt. I mean, just their covered call version beats Purpose by 9%. That is not too shabby. Finally, we have NVIDIA. The covered call version pegged to the Canadian dollar, NVDH pegged to the US dollar, NVDH.U. Once again, we have a management fee of 0.40%. Their dividend comes in at 18 cents per share. So that does work out to a yield of 18.31%. Looking at their leveraged version, the Canadian ticker comes in at NVHE, while the USD one comes in at NVHE.U. Once again, management fee the same, 0.40%. This time, I bet you're expecting a dividend of 20 cents because they tend to go up 2 cents. Well, you'd be wrong this one time. It's actually got a dividend of 0.22, and that works out to a yield of 22.45%. Looking at NVIDIA, year to date, they're coming in at 162.84%. So you definitely will lose some upside potential with this one. As usual, Purpose does have an NVIDIA ETF, and that one has a yield of 20.21%. So they actually do win that battle between these covered call ETFs. Of course, if you go to the leveraged version, then Harvest once again wins the crown with that 22.45, beating Purpose by a wee bit. These ETFs, without a doubt, they have some rather high yields that will make many passive income investors very happy. These can easily be a great addition to the income-focused investor's portfolio. However, you do have to take into consideration that these are brand spanking new. And as such, it is hard to make a case as to how they will perform in the future. In the current market, I believe they will be fine. But as Harvest gets a chance to see how the money flows with these, you could potentially see some minor adjustments. That, of course, is not to say that there are going to be adjustments. Just to be clear, if they got the math right when they were setting these up, then there shouldn't be any. Absolutely not. But as an investor, it always makes sense to be prepared for the good and, of course, the bad with the market. Never take anything, especially high dividends, for granted. If you are interested in any of these new Harvest ETFs, don't forget to put in a whole heaping helping of due diligence before you place any of your cash on the table. Let's continue that learning journey by checking out this video on VFV, and I will, of course, see you guys in the next video.